Okay, you are welcome back. And at this point, we want to look at another topic. A topic I regard as a must-know topic. Remember, I told you there are 3 topics at the introductory part of taxation that a student of taxation should be able to be handy with at all times. That is basis period, capital allowance, and loss relief, because this topic cut across other topics. So here we are looking at capital allowance, capital allowance. And for capital allowance, I want us to look at this topic in detail via this. First, definition. Definition. 2, we'll look at qualifying capital expenditure. Qualifying capital expenditure, or alias, you can say alias QCE. We'll look at conditions for granting capital allowance, conditions for granting. Permit me to use CA here, capital allowance, CA. Types of capital allowance, types of CA, capital allowance. Are you there? Basis period for capital allowance, basis period for CA, capital allowance. Next, disposer. Disposer of QCE. Okay, next, restriction of CA. Did you get that? Next, terminal CA. Next, second-hand building. Second-hand building. Okay, and then hire purchase transaction. Transactions. All right, this is an overview of all the issues we have to look at under capital allowance. If we can go through all of this, I will say we have done everything we need to know about capital allowance. Then we'll go to the computational aspect. These are just the theory part. I'll go through them with you. Let's start with the definition. Definition, okay? So I'm taking definition and then trying to give a quick one. Definition. For definition, I will say this. I always like to introduce my students to capital allowance this way. If you have a fair knowledge of financial accounting, I'll relate it to financial accounting, and you are asked to prepare profit or loss statements, you agree with me that one of the expenses, there is a particular expense that cuts across all profit or loss account. What that means is, if you are asked to prepare 10 profit or loss account, that expense will appear in all of them. If I ask you that, you will not forget to mention depreciation. Are you there? Depreciation. Depreciation. That is for financial accounting. In tax, the taxman forbids this word. Does not like this word depreciation. Why? He believes that different companies use different depreciation rates. You know, we talk about depreciation, we talk about rates. Different depreciation rates in order to arrive at their own depreciation. And depreciation affects your net profit. So because of the difference in the rate applied by different companies, which will result in different net profit, even though the asset in question are the same, the tax authority is saying, look, shut down on this depreciation. I don't want this depreciation, but I will give you a standardized depreciation. A standardized depreciation that will be applicable to every business, every company. as long as the assets are the same in all the companies. That depreciation is called capital allowance. Are we there? So capital allowance, in other words, is a standardized depreciation. Put aptly the definition of capital allowance. You say, capital allowance. This is an allowance that is granted to a business. This is an allowance that is granted to a business in any year of assessment. An allowance that is granted to a business in any year of assessment. It incurs qualifying capital expenditure in deriving its income. Key point there. It is an allowance. Okay? And it's usually granted to businesses. Why? That incur QCE, qualifying capital expenditure. QCE here is qualifying capital expenditure. QCE. That incurs QCE in deriving its income. In deriving its income. Okay? So, that is it. That is an allowance and is granted to businesses. Which type of businesses? Why? At what point? If the business has incurred qualifying capital expenditure in deriving its income, it's entitled to capital allowance. Are we there? Continuation. Capital allowance is a standardized depreciation. I have explained that there. Capital allowance is a standardized depreciation. So, maybe I should also put it down here. Standardized depreciation. Okay? Standardized depreciation. And that it is to be deducted from the assessable profit of a business before subjecting the balance to tax. Another point here. To be deducted from assessable profits of a business before subjecting balance to tax. So these are the key points in defining capital allowance. Take note, it's an allowance. It is granted to businesses that have incurred QCE, qualifying capital expenditure, in deriving its income. That is a standardized depreciation. Depreciation in another form, standardized. Okay? And that it is to be deducted from the assessable profit of a business before subjecting the balance to tax. So, that is the definition of capital allowance. In the course of defining, we mentioned a terminology that will look strange or sound strange to us, and that is qualifying capital expenditure. Qualifying capital expenditure. What is qualifying capital expenditure? So, let's go to qualifying capital expenditure. Let's try to see what we can do about that. For qualifying capital expenditure, say qualifying capital expenditure. What are they? Qualifying capital expenditure, these are expenditure that are entitled to claim capital allowance in any year of assessment. Expenditure that are entitled, so expenditures, yeah, entitled to claim capital allowance in any year of assessment. Any year of assessment. Are we there? Okay. In the other world, in the FA world, financial accounting world, we call this assets. Assets. They are assets that you depreciate. But in tax, we don't call them assets, we call them qualified capital expenditure. Are we there? So, which are the qualified capital expenditure? I will go through them one after the other. I'll list them down here and then we'll discuss them in detail. So QCEs, list of QCEs, I call them list of QCEs. Okay. 1. Building. For building, it's going to have A, industrial building, and B, non-industrial building. Non-industrial building. I will take time and explain industrial. And of course, if it is not industrial, it is non-industrial. That is building. Let's look at building first. Industrial building. Industrial building. These are expenditures in connection with warehouse, factory, workshop, mills, port, jetty, dockyard, etc. Are we there? I'll take them again. Industrial building. They are building or expenditure in connection with workshop, jetty, mills, factory, warehouses, port, dockyard, shipyards. Alright? So, if I'm to look at industrial again, I could just say e.g., warehouse. Let me just put down some things here. Warehouse, factory, workshop, okay, mills, etc. Of course, if they are not industrial, they are non-industrial. So any expenditure that does not fall into this is regarded as non-industrial. Why the difference? Because when we come to capital allowance rates, there are rates we apply here, they are different. They are applied, different rates are applied on this. So take note, your industrial building are your warehouse, your factory, anywhere you use as where things are done, production is on, work goes on, machines are running. We regard them as industrial building. Is that okay? Two. The second type of QCE now is mining. Mining. So what has mining got to do here? Mining. These are expenditure in connection with mines, oil wells, okay, quarry, and other mineral deposits of a wasting nature or exhaustive nature. Okay? So the key thing here, the key point to note here that it has to do with mines, quarry, what have you? These mines, quarry, oil wells, mineral deposits that are for wasting nature. The key thing there was is wasting nature or exhaustive nature. That is, they will one day be exhausted. They will, go away. Just like we are told that in the years to come, we will not have oil in those oil wells again. So that is mining. Let's look at 3, plantation. Plantation expenditure. Mining expenditure, plantation expenditure. What is plantation expenditure? These are expenditure in connection with initial clearing of land. Initial clearing of land, seedling, planting, harvesting, but does not include cost of replanting. It also includes cost of construction work that will be of little use when the plantation is no longer worked. 4, let me look at research and development. Research and development. R&D. This is expenditure in connection with secret formula, market evaluation, testing and development of products, provided it does not bring into existence a new asset. So what's the key word here? Whatever you're expending in terms of research and development should not result in a new asset being produced, being manufactured. Okay? Then 6 or 5, I have motor vehicles. Motor vehicles. Motor vehicle is motor vehicle. 6, I have plantation equipment. Plantation equipment. Okay. Next, I have public transport. 7, public transport. Public transport with at least 3 buses. Public transport. So for public transport, we are looking at least 3 buses. At least 3 buses. 3 buses for you to qualify for public transport. 3 buses. Okay. Next, I'm looking at, this is 8, plant and equipment. Plant and equipment. Okay. 9, I'm looking at ranching. Ranching. 10, I'm looking at furniture and fitting. Or 10, I'm looking at furniture and fitting. So these are the classes of qualifying capital expenditure. At this point, we will take a break here, and when we see in the next lecture or the next video, we'll move further as per the points I listed, the overview. If you go back to the overview, I'm taking them one after the other. So for now, I have taken definition, I have taken qualifying capital expenditure. Thank you.